Okay, the trade war between Canada and the US just heated up a notch. What does this mean for mortgage rates in Canada? Let's start with the Canadian dollar. It definitely took a hit. It fell to a 2-month low. That part checks out. Everyone expected that. But when it comes to interest rates, things are a bit more messy. There's two interest rate pathways in most countries, and they're both heading in opposite directions at the moment. The first pathway in Canada, the Bank of Canada. That's your variable rate. It's on hold right now at 2.25%, and the outlook is that it remains flat. And since this collapse in the CUSMA talks, the sentiment remains the same. If anything, it'll remain flat for longer rather than hike. Pathway number 2, the global bond market. This is the fixed rate territory, and right now, and even before this recent CUSMA debacle, it's been active and is constantly triggered by random and ongoing events around the world. And that's the key point. Bank of Canada, which influences variable fixed rates, is mostly influenced by what occurs inside of Canada. But the bond markets, which influence fixed rates, is broadly triggered by events that occur outside of Canada. So keep these two pathways in mind when it's time to decide on fixed or variable rates, because the outcomes for both are totally different for both near and long. Message me for the more in-depth version of this video, or search Mortgageonomics Canada to read, watch, or listen in greater detail.